One of the most interesting parts about being at a family office summit is when family offices interact with each other. And this is a topic we talk about almost at every conference, which is what do we do with co-investments? And co-investment is the strategy where the deal you can't get into is more valuable than the deal you can. We have 8 operators, or 7 now. Real estate operators, GPs, advisors, and we have from the US, from Portugal, and from Canada. They're going to tell you what they're actually closing in 2026 and what that says about the next 12 months. I know things seem very fluid. And we're going to be talking about that for the next 35 minutes. So welcome, everyone. The first question I'm going to kick off to, and to my good friend Pedro, and all the rest, is what is a recent co-investment that you said yes to, and what was it that closed it for you? And do a brief introduction as you go along.
Thank you. Good morning, everyone. Thank you, Anthony, for putting this together. It's a privilege and a pleasure to be here and to meet all these wonderful people. So I come from Portugal. I work in real estate and gold. Very traditional. I learned it and take this from my grandfather, and that's the reason why I wear this beautiful clock and ring. And what we are building is for ourselves, actually. A bit selfish, not to flip, for the IRR, but especially to provide the places we want to be living in the future. The most recent co-investment was the hotel in Trafaria, so Lisbon South Bay. Lisbon is a very hot city for the moment, and we are very honored. On the last event with Anthony, we met our partner in Dubai, and then we signed our partnership agreement when we landed in Lisbon. Now everything is ready. I like to deliver zero risk in real estate, and that is when you have everything ready, construction ready, and the only investment that we do is alongside with a bank that is putting 70% of the capital, doing the construction. So if you want to learn more, the very big project is Longevity Living on a very beautiful property, but I'll be happy to talk to you in person.
Thank you. Thank you, Pedro and Keith. Yeah, so I'm co-founder and CEO of Azure Printed Homes. We 3D print homes using recycled polymers, basically water bottles, and fiberglass. And most recent deal that I co-invested in was a customer who came to us, and I was just very impressed with their project. And even before they asked, I said, I think I'd like to be a partner of this. So, and both me and my brother, my brother's son, my nephew, just had a $400 million exit selling his company. And so we're investing along the same theme. It's going to be a glamping resort focusing on longevity, and it's going to be in Joshua Tree. I've never done a hospitality deal, but when you have a beautiful location, it's in the desert, right at the entrance to Joshua Tree National Park, and somebody who's using our product and somebody who we've known as a customer, it was an easy deal to say hello, to say hi, to be part of.
Good morning. Good morning. My name is Weston Smith. Thank you all for coming today. Again, thank you for Anthony and Keith for moderating today. I run Fortis Fortuna Holdings, which is a bespoke marketing consulting agency with not just advisory and consulting, but also access to some interesting rooms I do get access to. So a recent co-investment was actually in water. It doesn't sound very flashy, but I think water is a big issue of national security at this point. A couple of my friends do have DoD or DoW contracts to mine it from the aquifers in the US, because with all these data centers, they're going to need so much water to cool, and then also just clean drinking water to bottle and consume for ourselves. And the returns on water are quite staggering. So that's mine.
Good morning. How's everyone doing? Damon Harmon, the co-founder and CEO of Braganza Autocollezione. So I'm typically an investor in my startups. I'm an entrepreneur, so I'm usually the first investor. which I was in this. So we invest in luxury and exotic vehicles, and we place them with top-performing operators across the U.S. We also have a tech platform that helps make the systems and operations more scalable, protects the fleet. So we saw an opportunity in a marketplace that was highly fragmented, no standard authorizations, and basically no infrastructure, no tech that was running it. So saw an opportunity, like to solve problems as an entrepreneur, so invested in a pilot program in Southern California, and that has done well. And so now we have demand for over 300 luxury assets nationwide, and so we're starting a cap raise. So we're actually looking for money, because it's more than what I'm able to put in at this time.
Thanks.
Good morning. I'm Gonçalo. I am a founder of My Universe. It's now an ecosystem for real estate investments in Portugal and also in Bulgaria with the investment fund. So the last co-investment, to be the biggest one, was there is a shortage of housing for mid-market, at least in Europe. So we started as a situation, as a problem from one of our investment funds with 4 plots for construction, and now we are shipping to 17 plots in the same location, 115 units, like 30 million euros investment. We were grouping with foundation, investment fund, and GP as a single person. So it's a nice operation.
Good morning, everyone. Scott Bryson from Impactful Capital. So I solve an interesting problem, and my strategy is directly tied to co-investment strategy. We're solving the challenge at the early development stage of large 200 million to multi-billion dollar infrastructure projects. And so, what is a recent co-investment strategy that we're looking at is one where you get an early investment opportunity to see the development and the early de-risking of that capital and preparing everything ready for the institutional investors who want to participate in providing a big construction loan for $1 billion asset, but don't want to take that early stage risk. And so we specifically structure opportunities to allow families and qualified or accredited investors to participate in the earlier stages, and then the co-investment opportunities follow through the rights with that project, where normally these are not opportunities that are offered or maintained. And I think that in a world when we've got a substantial amount of volatility, the attractive opportunities to seek out and find are the ones with 30-year contracted revenue, guaranteed streams, and large fixed income assets to participate in. And so the only way you're able to develop these co-investment these opportunities is to participate in co-investment special design situations. And so an example of something that we passed on, something we were working on was a solar manufacturing facility or a solar project, and something we passed on literally just this morning was introduced to a real estate opportunity who needs a $40 million bridge to get to closing the land. They had a previous investor that fell through. It would be for probably a greater than gigawatt production of natural gas. And that is counter to our thesis. We specifically focus on sustainable infrastructure assets with long-term fixed customer contracts already in hand. And this project didn't have a customer. It's speculation. It's probably a safe bet that they're going to be able to extract natural gas, but it's a good example of one that we pass on because it doesn't have the confidence of a customer already in hand. The project isn't properly spec'd out. And it's really just a simple real estate play, and there's plenty of other investors for those things. So that's a passing example.
Thanks, Scott. Jimmy?
Yes, that's interesting because I've heard some of the same things I was thinking, where there are alternative ways to get to the co-investment side. Myself, kind of the opposite order that Damon has gone through, where I spent a number of years seeking capital. With a wireless retail company. We built our company over the last 7 years or so to a 200+ store chain of T-Mobile stores, and we sold it last year for it was the 3rd largest sale of that type of business in T-Mobile history. So along that way, we raised that capital, all the way from angel investing, which I was kind of the angel, all the way through the various seeds of growth, because we were doing that with M&A. And then during COVID, we really stepped on the gas during COVID because the buying opportunity was too strong to resist. And so that was really almost a emergency capital raising, and we did all sorts of things to get there. And then that got us to level enough footing. We were able to finish the deal with bank debt. So I say all that because I've lived as an entrepreneur through all of those stages, and so I had the opportunity to become a part after I sold the company because it was to a larger strategic. I didn't need to hang around for long, which is put that at the top of your list of things you should do when you sell your company. So I was able to go and become a partner and take over as CEO of a company called Board of Advisors almost immediately after that, because I'd been a part of that group and that community for almost 10 years and used them many times during the growth of the retail company in various aspects, and didn't use them. I partnered with many people in the group, whether it was the $150,000 for a deal that just came up and we had to close in 24 hours, or whether it was millions of dollars for a larger chain. I sort of built that company through the Board of Advisors network and the folks that they knew outside of that. And I can talk a little bit more about that later. I assume a question will intrigue it, but to me, so Board of Advisors now has over 100 people in it, and most of those are either on one side or the other. Like Damon and I, we're either raising or investing, and I think that permeating some organizations like that. And I'd be glad to talk to you about Board of Advisors, and there's others out there that do it. It seems to me that getting in early in those groups and getting those relationships developed not only could solve your lead flow problem or your deal flow opportunity right now, it can do that for years to come, because I've watched there's a number of founding members that were there 10 years ago that did exactly what I do, and they're back in the game now, just the reverse, and we're investing back into deals. So I think if you can get to those grassroots and permeate those organizations, it's a lifetime of lead flow.
Sounds like I need Board of Advisors. Sounds like I need Board of Advisors.
So very interesting. Going back to Scott talking about a deal he walked away from this morning. I'm not going to put everybody on the spot, but does anybody else want to share a deal that they've walked away from recently?
Yeah, I will. So there was a recent healthcare roll-up, and everything looks good on paper, right? As these things often do. But really, when it comes down to it, are you going to have a good relationship with that partner, with that owner, through the course of your relationship? Hopefully it's going to be a long, healthy, prosperous, profitable relationship. And the numbers were great, but just the human dynamic wasn't there. So, which is an often overlooked piece, I think, in this industry. We all have the dollar signs in our eyes. I think we're all guilty of it at one point or another. But this one, the owner just wasn't quite a cultural fit for us.
Well, in our case, it's one of the clients that we work, very successful entrepreneur, and exited many businesses. And in real estate, he was applying the same mentality of high profit for himself. So because we represent more than 1,000 families investing together, for us, it's more important to make money for everyone than to privilege one person only. So we moved away from that partnership. He stepped out of the president of the board. It was a very fancy name to be in the president of our board, but definitely much more happy with the team that we have today that understands to think about decades and not quarters.
All right. Well, I was telling Anthony that a couple of weeks ago, there's an annual very small conference in San Francisco. Two of the original VCs, the original, Pitch Johnson and Bill Draper, Tim's father. And what it boiled down to is that ultimately in that room were relationships. And so I'm feeling that theme, hearing that theme. When we talk about VCs, for those new to the conference, we talk about VCs. They want to return to their investors. They need to do it relatively quickly. Family offices are what we call patient capital, right? And different families have different philosophies on what they're going to invest in, why they're going to invest in, and then they have an opportunity to take a little more interest in the companies that they're putting money into. So I hear that theme just being woven through this panel. I wanted to actually go to Damon, because you've seen a couple sides of this. How are you building those relationships?
Yeah, that's a great question. So, events like this, meeting, folks that are looking to deploy capital into new sectors. But in many ways, we're also sort of co-investing. We're making an investment into the actual operators who run these rental agencies, right? So they've built their business to a certain level. They've kind of hit a ceiling, and they're no longer to expand, but they've done the first thing right. They have lots of customers. They're doing the marketing. Look, at the end of the day, is it really that hard to rent a luxury car? Ferrari, Maserati, Lamborghini, they're brands that people already desire and they want. But once you get those customers and this influx of business comes in, that's where you start to realize if you don't have a structured foundation for standard operating procedures and ways of protecting both the renter and the vehicle, you start leaking money and profits are coming out the door. So for us, we're building relationships with these operators. They have to meet our standards and they have to adopt our technology, which helps them scale and become more efficient. And we're literally investing in them by providing them with the vehicles that then create the revenue. So that's one side. On the other side, we just opened a Series A. It's a $100 million raise for expansion to meet immediate demand. 80% of that capital is going into these assets that will be debt-free. And so we're looking to meet investors who can really understand that this is not about, luxury cars. It's about owning the infrastructure that allows that to scale, this luxury asset. And we have, a pretty good program put together that pays the investors well.
Thanks, Damon. Gonzalo.
Okay. Our relationship with VCs in real estate is doing a case-by-case operations on opportunistic real estate. So we are trying to shift the way we do business with VCs. So we bought a structure, investment fund in Bulgaria, so we could organize all the cycles and to have a regulated structure where we could wrap everything. So decisions, governance, and opportunities.
Thanks. Scott.
So I can talk a little bit directly about how we work with venture capital firms and families that also have made venture-style investments. Venture, especially in first-of-a-kind technologies or newer technologies, or investments that families or funds have made over the last decade. A lot of these technologies will have gone through their pre-seed, seed round, through their Series A. They'll have secured a commercial contract or customer, and now they're ready to build maybe their first commercial facility or nth-of-a-kind facility. And a lot of the time what happens in the market is that another subsequent Series B round or Series C round goes through. And what that is really damaging to families and funds, because that adds another dilutive layer to your equity that you put that capital in early. And that capital going to project financing a manufacturing facility at the tens of millions of dollars of capital that's necessary to that is incredibly dilutive for the wrong purposes. And it's because of the institutional investors' inability to invest in this early stage. So what that means, this is why I created Impactful Capital, but what it means for opportunities for families and fund managers today is that look through your portfolio, understand which companies that you've already made those conviction investments into, and you can develop your own co-investment opportunities within each of those different assets and look at those project financing opportunities and the projects to support your technologies that you've started at an early stage. And that is your co-investment opportunity right away. And that can protect your venture investment that you made at that earlier seed. And you can also develop the ability to have and originate your own fixed income asset from within your portfolio, or even within your own family's historical portfolio. I've also worked with families and discussed and talked about their existing assets from cold storage facilities around the world, to agriculture production regions, to energy projects that they have, and then not really understanding the own co-investment opportunities within their own portfolio. So that's really how I work really well with venture funds, and I think everyone really can if you're creative in thinking through those.
Thanks, Scott. Janine.
Yeah, I agree with Scott. Coming from both sides of the table, I really believe in that theory of working that relationship all the way through. There's so many different stages, we can use the saying a lot that it's a lot harder to get them than it is to keep them, or a lot easier to keep them than it is to get them. And I believe that is really a general business theory where, why don't you ride that horse as far as you possibly can, so you get in early, you find that entrepreneur that you know is going to take it. You got to have the entrepreneur, you got to have the CFO. To me, that's as or more important in early stage investing and potentially investing in a company that you're going to take the full ride with, is to have that entrepreneur and CFO that have the experience and ability to do that. And I've seen that proven, and I've proved it time and time again. And you just experienced it. Gene down at the other end there, who he's actually one of the members of board of advisors, and I delayed my family ski trip by a day because he insisted I come see his factory, which is wildly impressive. And then I think that was a Sunday maybe, or a Monday, and then the next day I got to know him and his partner better, and the next day I invested in his business. And I'm betting he's got great technology, but I'm betting more on him and his partner than I am on the technology. And I think I'll have round 2, 3, 4, 5, and 6 with him, and then a really nice exit. And so to me, that's the magic. If you can pull that one off, get in early enough, ride that talent, and take it through a few phases.
Thanks. Gene, did you want to go?
Yeah, and I'm going to follow on what Jimmy said. It's investing makes sense in something that you understand the business, and feel comfortable about the team. Just like Jimmy said, Pedro and I have been now meeting for a couple times, and it's only when you get to know somebody you feel comfortable doing business with them. That's the bottom line.
Thank you.
I just want to note on the co-investment, many people in the room, they are founders. They have been dedicated to their businesses and struggling sometimes and feeling isolated, not sleeping at night. Co-investment is about this, is about raising a hand. God will for sure find you the right partner. I am on the verge of having this partnership with Gene as well. I love this project, but it's just making it easier for everyone, and not only easier, but more impactful. We do more together than we do alone, and so this is the invitation. If you're still working alone on your project, struggling and fighting, try to find a hand that will help you get there faster, better, and more impactful.
So I'm going to ask this question. I've heard another theme, which we've talked about relationship, and a few also talked about systems and tools. And to me, that coming from a governance background, is governance. There's so much information available now, and we worry about signal from the noise. I don't know if it's a fair question to say which matters more, because I think personal relationships, to me, still is more impactful. But I wanted to know how each of you blend the thought of that there's data available, but then you have to filter that. I want to start with Wes. You kind of mentioned that earlier as well.
Sure, yeah. So, it's the way any investment is set up, even if it is a VC, family office, whatever, it is all about structure and governance. So like do the bylaws, do the board of advisors, do they actually have paper worth their weight? And how is it enforced? Or is it just a bunch of LPs getting together, reading the quarterly sheets that nobody reads past page 2 or 3? And again, that really kind of doubles with the relationship side. If you don't like how a company is run, but the numbers are good, maybe you still step back because of that. So are they actually, are they worth their weight? Do they have the teeth? Are they going to be enforced? Or is it, again, just more LPs reading through the quarterly sheets? Oh yeah, that looks good, or are they actually more invested, not just monetarily, but relationally in that business, in that firm, in that fund, in that family office?
Thanks.
Yeah, sure. Yeah, I mean, numbers and data are important, but intuition is everything. And so, talking specifically about, like, for instance, buying cars, similar to real estate, you make your money when you buy. So we don't buy new cars. We buy cars that, have already got depreciation that's been taken out of them because of mileage, because the renter doesn't care how many miles are on the car. So we have all the data to tell us when is the right decision to buy and when the right decision is to sell. But intuitively, this is a car that's special. The people want it. It's desired. And so, maybe you make a color change, maybe you do something to it, add a modification, and you squeeze more life out of it. So intuitively, if there's an asset that we're like, hey, it's time to exit this, or maybe we shouldn't buy that one because the numbers suggest that we shouldn't. So this is an example of how we, use data, but always look at the intuition as well.
Thanks, David.
I'm just sharing about governance and relationships. I give an idea. We cooled down with an investment fund recently, exactly because they changed the governance. And for me, it's more important than rather just doing some deals to have a trust. But in the opposite, normally it's the trust the VC on you. But I changed because I stopped calling to work with them exactly because their governance was not anymore aligned what we wanted to do. So it's a different answer to this question. It's just to understand the other side is also needs to pay attention to who we are working with. So that's, I think, a different answer.
For me, governance is super critical for the types of transactions and work that we're doing. We're originating and streaming towards institutional capital for every one of our transactions. And so when you're trying to work with Schedule I banks globally, when you're trying to issue billion-dollar green bonds to refinance after a construction loan, for a decade or 2 decades long for some of these types of financial instruments, you have to be perfect. There's no room for error in doing that. And so where we domicile each individual project investment is conditional on which country and which currency and where the capital is being pulled from and which currency and being deployed into that. So these are all really critical. And so we try to bring that level of governance to the earlier stages of the project development in large infrastructure, in the beginning stages of large infrastructure projects. So it's a really important thing. And then sooner, there's a balance where you don't want to have too much oversight and too much red tape to get and slow down projects at the early stages, but it's really important to establish those frameworks. And then the other piece I'll say to this on why governance is really important from a co-investment standpoint is that we're trying to provide the LPs the ability to be able to continue to stay invested into these assets if they want to. And so we're providing this optionality into staying into an asset for the next 30 years if they want to. Or they could stay in for a 6-month time period or a 1.5-year time period. And the only way you can achieve that is through governance structure, through the contracts that you're signing in the transactions and with the LPs. So it's a really, really important thing to really think through what your strategy is and how that benefits the LPs who are taking that earlier stage risk in these assets.
Thanks, Scott. Jimmy?
So yes, and a lot of what I heard here supports the view that I would have of it. And of course, I'm a little bit biased here because I have one of the organizations that you can come and sort of start from the top down, where and I heard somebody telling the story yesterday that they had a really nice deal that they'd worked through. It had been the 90, 120 days of due diligence and all the processes and so forth. And then the CEO walked in at the end and just blew it because he was just an arrogant, and was starting to tell the banker, the bankers, the investors how it was going to work, and so somehow had this real big idea about himself. And you all have seen that, or you get in front of the CEO and you realize that he might be a nice person, but that doesn't mean they can take the business where you want to take it. So, I'd still advocate for getting immersed in organizations and some of that, what seems like, boots on the ground, cumbersome way to do it. I would argue it's more efficient because you start at the end and work back to the beginning, and you get in and out of the evaluation a lot quicker and get to the next deal, whichever way you go with it. And there's other organizations out there just like mine where you can walk into deal flow like crazy and you can make 15-minute decisions and 30-minute decisions or 30-day decisions or 90-day decisions. But you might as well clean out the crud right out of the way and see who you do relate to. So.
All right, well, just take a moment to thank everyone for their time. And again, this always goes really quick, learning a lot. I think in terms of the summary between relationships and the data and how do we actually I still think, at least in our experience, that for co-investments, it's usually direct information that you're shared in rooms like this. So Anthony, I want to thank you again for having me here. Good seeing all of you, and thanks again to the panel.
Thank you.
Welcome back up.